managing partner at Tanto Capital. Ozan, I'm going to ask you a very basic question. What do you make of what we are seeing at the moment?
I think the market is quite confused as to why this is happening. But then again, we've been discussing since the beginning of the year that the move that we witnessed so far in the markets is very sentiment-driven, momentum-driven, AI-driven, innovation-driven, with sprinkles of geopolitical risk, trade risk all around. So although we haven't got a specific reason why there has been a sell-off on the back of the strong NVIDIA results, to me it's not that surprising. It's only a matter of time until sentiment just shifts, because we just live in a much more uncertain world. I mean, you just mentioned in the program a minute ago, right? I mean, we have so many things to choose from. Long-term debt as an asset class, is it feasible anymore, right? If it gets repriced, what happens to people that have leverage? What happens to the corporate balance sheets that need to continue to borrow to continue growing and investing CapEx? Not everything is about financial markets. A lot of it is about also the real economy as well. So we have so many things that we can choose from to justify why there's a sell-off, but the reality is no one quite knows at the moment.
Does there need to be a catalyst, though, to see a sustained popping of what many say is a bubble? Because a lot of the factors that you just mentioned, they've been swirling around in the background for some time now. But ultimately, we've seen pullbacks, and then the market just continues higher from here. So do we need something to actually burst the bubble for it to be sustained?
I think it's a great question. I don't think we need to see anything specific, although there are a number of things that can happen that will make sure that this is sustained. But I think the most dangerous place we can be at is if this continues, even if it's at a low intensity, and the sell-off continues for a while longer, and then people and portfolio managers start thinking, hey, maybe, just maybe, we do need to kind of hedge out and kind of, either lock in gains or make sure that we redistribute the portfolio. I think that in on its own is a dangerous mindset, but we are not there yet.
So that is the polar opposite of what I think.
Really? Amazing.
Yeah, that's what makes the show. Maybe I'm a little bit dramatic. That's not the polar opposite. But why shouldn't they? This is what really gets me about asset managers. And actually, do you want to get that VIX up again? Will's got it. He's got it ready for us. This is where the VIX is now. It's a fear index. Yeah, fear index, which is obviously not. It's trading at 26.4. It is up 56% over a 1 year period. It's up dramatically over last week as well. You just said a really dangerous place to be is when asset managers start taking out hedges. Why? Why shouldn't those asset managers put on hedges all the time?
Okay.
I don't know why, because they're benchmarked and they're terrible about losing a couple of basis points compared with their peers. But no, hang on a second, Ozan. I'm going to give you a full carte blanche. I'm just going to moan for a bit first. Why shouldn't?
It's Friday. It's that sort of a morning.
Bear with me, guys. It's a little bit of theatre. Okay. Well, it's TV. Why shouldn't they put on hedges more often? Why do they wait till the market dumps 5% before they buy the VIX and they buy some puts? Why shouldn't they actually have a hedge on if they're being responsible?
The short answer is all about the compensation cycle, is all about the human condition, is all about the way incentives are structured. And Steve, no one cares about the long term. Everyone is dead in the long term. No one even cares about the medium term. It's all about short-term cycles. So it's unrealistic for anyone in the market to expect.
So I should just ignore my adulation, my lauding of the great words of Warren Buffett. I should ignore Benjamin Graham. I should ignore Charlie Munger. I should ignore the greatest investors because they don't care about the short term. They care about buying good companies that are going to be there over the bit you just said doesn't matter, the medium to longer term.
Well, I'm not saying you should ignore them, but value investing takes a specific mindset and a specific strength of balance sheet and conviction to see through and have a truly medium to long-term view. All I'm saying is that your question was about asset managers. How many asset managers do you know that can afford to think long-term? I'm just saying that the reason why I think we are witnessing this sort of a reaction is because
can't they do what these brilliant your industry? How can't they do what the PE guys do? They've got this wonderful phrase: continuation strategies. We've got continuation funds. We've got continuation funds, which basically means they can't get out of something, so they've got it for longer.
Excuse me, PE guys. I mean, the era of cheap leverage. Okay, I mean, I'm not going to get onto that.
All right, I'm done. I'll get off my soapbox.
I kind of value a bit of Friday morning ranting. It's okay. It's been that sort of a week.
Well, I think you're spot on. I mean, when you think about how much the market is now dominated, I have to say it's probably moved on from your days in the trading pit.
My days.
Your days. Can I add one little point on that? I think one thing to watch out for, a data point to watch out for, is about that fiscal stimulus program that Japan is looking to kind of exercise, that $135 billion or 21 trillion yen. The reason why I'm saying that is, this year we witnessed a couple of times government of Japan try to issue a 20-year, didn't really go down that well, a 40-year, didn't really go down that well. And they kind of settled on a 10-year part of the curve, which is really where the comfort zone for debt investors are. So my question to you is, since we're having a Friday morning ranting session, I'll take my time as well.
It's therapy. It's cathartic.
It's fantastic way to start the morning, by the way, right?
Well, I mean, my session, I've just been told that I'm old-fashioned and everything's moved on since my day.
Why or how could investors bet on long-term debt as an asset class? And what does it mean for the future of the cost of debt, cost of equity, cost of capital? Because no matter what the Fed does in December, or ECB, or Bank of England, or Bank of Japan for that matter, I think we're in an era where cost of debt, cost of equity, de facto cost of capital is going to continue to rise. And that is going to put a lot of business models under pressure, and they just haven't woken up to the fact that their going concerns may not have much of a chance in this brand new world. So I think that's the point that I would focus on. But the reality is year end. People need to get paid their bonuses, and it doesn't pay to be bearish unless we see a sustained level of a sell-off.
Well, this was going to be my point, that since your trading days, the market's become a lot more dominated by pod shops and multi-strat hedge funds, which have a completely different incentive structure. So even if you believe that the Fed is going to be cutting rates next year, we're going to get a more dovish Fed chair. If we're not going to get cuts in December and January, do you want to be positioning for something that's going to happen 6 months down the line right now? It's just not working.
It just won't pay, right? I mean, if you think about back into, what was it, June, July, summer of 2022, when the tech valuations, the era of revenue multiples were suddenly gone because Jamie Dimon went out and said, hey guys, maybe this is a little too heated. So, I mean, the market doesn't necessarily need to have a big event for the sentiment to shift. And that VIX numbers are interesting, Steve, because it does show, the fear index, right? But it really does take a cohort effort.
It doesn't show fear index. It shows. What is it? It's just a measure. Why don't we just remember what the VIX is? It's a measure pretty much of the most active at the money near month options contract. It's just whether people are buying or selling it. Look, if the market goes up, everyone's selling it aggressively, selling premium. If the market goes down, people are buying the puts aggressively. But it never leads. This is my point. It never leads. It always reacts.
Yeah, of course.
So it's no more a fear index than looking back at the Nasdaq having fallen 2.5% in the previous session.
So what kind of a week do you think we're going to have next week?
I don't know. That's not my job. Your job. You're the one who's got to manage money.
So
I just react to it.
Look at just transpose the comp cycles. At least that's what I try to do. Try to understand who these portfolio managers get allocated through, and what do they feel like. And that point about Jamie Dimon, saying that the revenue multiples were crazy thing, it was the one comment that kind of made people think, oh, you know what, maybe they are. And guys, those that are allocating, start looking at cash flow, start looking at profits. So the sentiment shifted just through a couple of news flows that dropped in. And I think we are in similar territory right now, although we can have our picks from trade wars to geopolitical risk and everything being repriced. So happy days.
Nice.
Ozan, thanks for stepping in, creating a little bit of fodder for this morning's show. So thank you. Ozan Askrol, founding managing partner at Tanto Capital. Coming up on the program, the U.S.